So yes, we're looking at factor investing in emerging equity markets, and really the starting point for investors, for most of them, is that they want to get some exposure to emerging markets. They want to be globally diversified, and so they're thinking about how to include emerging markets in their global equity portfolio. Of course, they could do that through traditional passive investing using cap-weighted indices. Those have performed relatively poorly if you look over the past 3 to 5 years. Or as an alternative, investors, of course, could use active managers. And there are lots of kind of specialized active managers that claim that they have some skill or knowledge about these emerging markets so that they could actually extract outperformance from that. But also over the past years, investors have been growing increasingly skeptical also of the benefits of active management in emerging markets. And so factor investing is really an alternative to these approaches. So the idea would be that investors can just harvest factor premia by tilting towards these factors in their emerging market portfolio. But that, of course, leads to the question, well, what are the relevant factors in emerging markets? Factor investing initially was established typically in US equities and developed markets. And so the question really is, if you invest in emerging markets, what are actually those factors that can give you a return advantage? And that's the question that I want to address. Now, there is a maybe surprising answer to this question. Going back to academic research as early as about the turn of the millennium, where people basically came up with evidence looking at emerging market equity, and the kind of overwhelming result of these studies is that you actually tend to find the factors that have been documented on US data and developed equity data, and those same factors also show up in emerging markets. So you have one very kind of popular and early example, which is this paper in the Journal of Finance by Ruvenhorst. So I have this quote here. So basically, the paper argues that if you look at the evidence, basically we're quite confident that we have similar factors in markets around the world, whether it's emerging or developed markets, that actually drive differences in returns in equity portfolios. And so tilting to these well-known factors, so these are things like value, momentum, and similar factors, that also works in emerging market, so that increases returns. Now, this is a very early study, so this is a finding that has been repeated, of course, since over those past 20 and 10 years. Even in developed markets, the set of factors has evolved, and we're now looking at additional factors like, for example, quality-related factors. And all those factors, really, they also show up in emerging markets. And so you have a list here of some papers that contain this evidence that has come up basically over the past 20 years, showing that, well, the typical factor models, typical factors that we work with in developed markets, they also hold in emerging equity markets. And just to illustrate this, I'll show you here the returns to standard factors. So these are, so you could use different data sources for standard factors. So these are data sources from Farmer and French. So they publish their long-short factor returns for the popular factors in their model. And you can see here, if you look at emerging markets, or for example, the US or Europe, if you look at these premiums to things like size, value, profitability, investment, and momentum, well, we actually see that very similar premiums show up in emerging markets. So if anything, these premiums to things like value and momentum in particular actually look quite attractive in emerging markets compared to some of these developed markets. So you have these are annualized return premium, and then in parentheses you have the T statistics, indicating that these are actually significant. And there's really, from this result, it would be difficult to make any argument that somehow these factors behave differently in emerging markets. The premium look quite similar. So investors are interested in these factors because exposure to these factors drives higher returns of equity portfolios. But there's another interesting feature of these factors, and that's relatively low correlation across those factors. So investors like to hold multi-factor portfolios because there's some cyclicality in each of these factors, but when you combine them, some of the cyclicality smoothes out. And this smoothing of this factor cyclicality, that's actually possible because of relatively low correlations. Now, this again is a popular feature that investors exploit in US equities and developed equity markets. And here you can see that in emerging markets, these factors also have very low correlation. So again, these are the same standard factors. So you have the, just for information, you have the market factor, and then you have these 5 style factors from the Farmer-French model. And you can see here that you have very low correlation. So, you could cite some of the popular examples, like, for example, if you look at so HML, that's the value factor. So HML actually has very low correlation with profitability, which is the RMW here for robust minus weak profitability. So you get a correlation of actually negative 0.5, so minus 0.51. And this is, again, a very kind of known, well-known feature in developed markets as well, that especially profitability and value actually good complements because of this low correlation, even this negative correlation. And that also shows up in emerging markets. So again, you see this this idea that factors are actually very similar in both emerging and developed markets. So overall, there's really a strong case based on the evidence to use these standard factors when you build portfolios in emerging market equity. But of course, you could be a bit critical about this, and you could actually object that, well, clearly there are differences, important differences between emerging and developed markets, and so you might think that it's a bit odd that these differences don't actually show up in terms of which factors are priced, and so it seems reasonable that you could also object to this idea that we can just use the same factors across different markets, and I would just like to address some reasonable objections, and I'll just show that considering this actually makes the case of the standard factors in emerging markets even stronger. And so I'd just like to go through 3 considerations. The first one is, well, what about some of the risk factors in emerging markets, things like political risk? Shouldn't that have an impact on the type of factors we talk about? Secondly, I talk about what happens when all of this is known, so publication effects. And finally, I'll talk about transaction costs, and intuitively, those should be very different in emerging markets. So shouldn't that have an impact on the factors that we're using? So let me start with some of the risks that you may think about when you think about emerging markets investing. So you could think about political risk, governance risk of those companies, currency risk, etc. And so obviously here, you could think that you're facing very different risks in emerging markets. And that, of course, might be true. The whole point of factor investing is that you're actually focusing on so-called priced factors. So you're basically focusing on the type of risks that actually are rewarded. So where exposure to these risks gives you higher returns. And of course, that doesn't mean that there's not other important sources of risk. And so you have something quite similar when you think about developed markets, or say US equities. Using factors doesn't mean that you believe that industries don't play any role. Obviously, an important driver of risk could be the the kind of the business sector that the company operates in. So you can have these industry risks, but it hasn't been shown that these industry risks are actually priced sources of, or actually price sources of risk, that they actually lead to any reward. And so this is quite similar for the kind of risk that you may think about in emerging markets. So there's, again, this very sound evidence that standard so-called style factors like momentum, like value that I've just listed are actually linked to a reward in emerging markets. but you don't actually find evidence that things like country risk or a political risk in emerging market actually carries a reward. And so what we're just saying is that basically these standard factors, they provide reliable sources of rewarded risk. This doesn't mean that there's not other sources of risk, but you will find a lot less evidence that actually some of these factors like political risk actually carry a reward. So if you're an active manager and you have some, either superior information or superior skill in processing information, and you can make some prediction about, for example, the market is underestimating some political events in a certain country. And, if you can predict this correctly, obviously you could make money out of these unrewarded risks. But as a factor investor, where you're just basically, trying to, get exposure in the long term to factors that will deliver a reward and, without making any prediction on events, this is obviously not something that is useful for you. So as a factor investor, you would really try to focus on these rewarded sources of risk, and anything else you will basically try to reduce exposure. So I've indicated this here with this traffic light system of these different sources of risk. So you can decompose, your return to your, let's say, your emerging market equity portfolio into these different components. So what is indicated in green is basically the exposure to these rewarded factors, things like momentum value, times their premium. That's the return component that you're getting from these rewarded factors, and that's what you would focus on as a factor investor. You would have other exposures to unrewarded factors. So this could be political risk, could be currency risk. So these are not specific to one single stock. There's some commonality, but what you would like to do is basically try to keep your exposure to these risks as low as possible. And then finally, you have these firm-specific risks, right? So you could just be exposed to, management decisions of one particular company, and that's something you want to, again, basically just diversify away. And so, the evidence suggests pretty clearly that these standard factors are, the relevant ones when it comes to long-term rewards. Of course, that doesn't mean that, there's not other factors that drive some short-term movement, and so they can be important. But your concern as a factor investor should be to keep your exposure as low as possible to these unrewarded risks. Now, another objection you may have to these very simple and very standard factors like value and momentum is, well, this paper that I talked about, published in the late 1990s, and this whole nice list of additional academic references. Well, they provide evidence that these premia were present in the data that they look at, but maybe that's not a very fair comparison or like a very relevant assessment for investors, because investors today, well, they're gonna invest in conditions when actually everyone knows that these factors exist, and so things that have been shown in data from the 80s, from the 90s, and so forth. Well, you have to admit that back then, what you see in the data basically occurred during times when people didn't know so widely about these factors. And so there's always an important question, what happens when actually everyone knows that you could just tilt to momentum stocks, you could just tilt to value stocks, and that gives access to higher long-term returns. Then of course you could have a risk that when everyone knows about these factors, these returns that have been so carefully documented, will just disappear. So in other words, these premia, they might be, in the data, but they might not be exploitable by investors because you have this, publication effect. Once everyone knows about it, this premium might no longer be there. So this is something that has been studied quite extensively, and there have been findings on US equity that indeed show that there is some what people call post-publication decay of these returns to factors. So what the evidence suggests is that, well, these premia, they haven't disappeared after they have been published. So even when once everyone knew about momentum and value and so forth, these effects, they still show up in the data, even the most recent data, if you exclude the initial period of the initial studies. So they haven't disappeared. They're still positive, they're still significant, but they are still much lower than what was shown in the initial sample. And there's a famous paper by McLean and Pontiff that basically shows this, asking the question, when you have all this academic research on factors, does it actually destroy the premia that academics document in the first place? And their answer based on only US data is no, there's no destruction of these premia, but there is some reduction of these premia. So people have since looked at the same question across markets, across the world, and just looking at not just what was documented in initial studies, but also looking at what happened afterwards when this effect was widely documented. And here you have estimates of these effects. So this comes from a recent paper in an academic finance journal. And so they estimate this post-publication effect. So these numbers you see here, so the rightmost column on post-publication, that's basically, if you will, a percentage change in the magnitude of the premium after that premium was published. And so you can see this U as a result, which is indicated below. So that basically means there's a 45% reduction in premium when you go from kind of the initial sample of the study to a setting where the publication was already out there. Now, for comparison, you see here the main emerging markets. So these have all the major emerging markets, like the largest ones in terms of market cap, like China, for example, like Taiwan, Korea, India, Brazil, but also some other emerging markets. And actually what you see here is that you do not see any reduction in these premiums. So, some of these numbers are positive, some negative. Almost all of them are not statistically significant. And so basically what this means is that after publication of these premiums, there was actually no reduction when you look at emerging markets. And so again, that means, well, the standard factors, it seems like they have an even stronger case in emerging markets than in the US, for example. And so they seem quite reliable even when people know about that. Now, the last objection I want to turn to, which again is an extremely reasonable one, is, well, what about transaction costs in emerging markets? Yes, you might have something like a momentum strategy where you're just looking at the past winning stocks, and that kind of changes quite frequently, so you're actually generating some turnover. So maybe that's fine in US markets where this turnover will not generate so much cost, but emerging markets are still a lot less liquid than the largest developed markets, and so looking at these factor premia just on paper might just not be relevant for investors, especially in emerging markets. So we've done a study on this at Scientific Beta. So basically, we draw on like the latest academic methods to estimate transaction costs. So these are not just kind of heuristic estimates. We're actually looking at the kind of methods that have been shown to work quite well and approximate very well the real-world transaction costs. The methods we used are actually slightly conservative, so we would tend to maybe overestimate a bit the transaction cost, and that's simply because we don't assume any kind of smart trading. So basically, we just assume that you're trading at, with using market orders, so you don't do any, you could just use limit orders, for example, to reduce the impact that your trades have, and these estimates just assume you're just blindly going to, for example, sell the stocks with a market order when the strategy tells you to. So that's why they're maybe slightly conservative. And you see here on a multi-factor strategy, so this is for across 6 factors, you see that on the rightmost column, you see that these strategies tend to have a turnover of about 30%, 35%. In the US, that leads to only 1 basis point of cost, transaction cost. In emerging markets, that goes to 17 basis points. Now, that is, as intuition suggests, a lot higher than in emerging markets. But if you think about an annualized 17 basis points, that is still an order of magnitude lower than the typical factor premium. So if you just go back to what I showed initially, so you have return levels of something like 2%, sometimes 5%. So clearly 70 basis points is not fundamentally going to change this picture. And so even though transaction costs in emerging markets are substantially higher than in developed markets, typical factor strategies still wouldn't be heavily affected by transaction costs. And so these claims about standard factors actually survive also consideration of transaction costs. So overall, there's I think a strong case for harvesting the standard factor premium in emerging equity markets. As I said, maybe the case is even slightly stronger than in developed markets because you have, it seems to have more reliable results, if you look at this publication effect. And so there is a good reason to turn to these factors. But of course, investors need to think about practical challenges. So what I've talked about is just, very stylized strategies. And so when you actually implement these exposures, of course, you have to think about doing that efficiently. What's the right portfolio construction? And so this is something that is important for investors. And so that's what we'll turn to in the second part of the presentation. Thank you.
Okay, thank you, Felix. Welcome, everybody. So we're going to talk about performance of the scientific beta EM strategies in the second half of the presentation in relation to the overall EM universe. And what we're going to try to do is give you some understanding what elements of the scientific beta process are responsible for its outperformance over the last 5 or so years. So with that, let me set the stage by just giving you a little snapshot of why there is so much concern over emerging market equities in the broader investment universe or world, especially with regard to asset owners. On this page, we see a 5-year annualized return for the MSCI EM index and the S&P 500. And as you can see, the S&P 500 has vastly outperformed the MSCI EM index. And conference after conference that I get invited to speak at, there invariably is a EM panel. And there's one conference in particular where the moderator had a set of fundamentally driven EM managers on stage, and she bluntly asked them, is there really any point in investing in your asset class anymore? And so you had 5 or 6 individuals with frozen looks on their faces trying to come up with some answers. So the challenges are real, but as we will describe and demonstrate for you, the scientific beta strategies have not fallen into the same traps, if you will, as other EM equity strategies. And it's interesting and I think informative to understand why that's the case. So stepping back, I think one of the things we have to recognize and really appreciate is that the EM universe has changed over the last few years in major ways. Now, Felix had mentioned priced and unpriced risk. And, there have been a number of countries that have dropped out of the, let's say, MSCI EM index, which is representative of the broad EM universe. And one way of interpreting that dropping out is that for a number of countries like Russia and Turkey, their unpriced risk has overwhelmed the price risk in their markets. And thus, the investment universe has deemed them uninvestable to a certain extent. And so they have either dropped out or had their weights radically reduced in the EM universe. Whereas other countries, Saudi Arabia, Thailand, and Indonesia, have actually increased their weights. Now, how is that relevant to the challenges for the broad swath of EM managers? Well, a fundamentally driven EM manager, for example, will typically have a team that has country expertise, or we hope that they do, right? And often these individuals have spent considerable amounts of time in respective regions, countries, have become experts on various countries and business cycles and the markets and so on and so forth, currencies, what have you. Now, so for example, if you had a Russia expert on your team, well, that individual's value add is radically less than it was 10 years ago. And now you have to find a Saudi Arabian expert, an Indonesian expert, et cetera, down the line. And you really have to readjust the priorities of your team. And so what I think the curveball, if you will, has been for many fundamentally driven managers, has been that they've had to adjust their process by trying to rapidly build up expertise in areas where they previously had none. Now, a quantitative process like ours does not have that challenge because our process looks at stocks and analyzes them using a factor framework And as we'll go into detail, there are other elements of it as well to ensure diversification and the removal of idiosyncratic risk and so on. And so, we're not running out and trying to find an expert in one country or another. We're taking companies as given and analyzing them with their factor exposures, and we let our process tell us what is attractive and what is not. So I think the changing landscape of the EM universe is an important aspect of the challenges and woes, quite frankly, of many EM managers, and I think it's important to appreciate that. So what do we do? So as we mentioned, and I'm sure all the audience members are aware, we have a quantitatively driven factor approach to EM investing. Now, we have a 4-step approach, and I'll discuss those in considerable depth in the coming slides. But as a basic overview, we begin by building single factor sleeves for each factor. And so we're literally going at the individual stock level and building up factor portfolios for momentum, for value, for investability, et cetera. Then we account for negative interaction effects, which I will discuss. And then we diversify the idiosyncratic risks away, because we are trying to eliminate any sort of name-based return, if you will, right? We want to essentially extract and harvest factor premia in as pure a form as we can, at the same time controlling for various risks. But we don't want any one name or two names to dominate the performance of our portfolios. And then finally, we equally weight the results of various optimization schemes to ensure a diversified multi-factor portfolio. So step 1, academically validated factors. I won't say too much on this slide because Felix has gone into quite a bit of depth on this. But what I want to stress here is that, in essence, as we talked about, if factors are prevalent in emerging markets, in the US and developed markets, essentially what that means is that if a country has a functioning capital market, the companies in that market will be, the behavior of the companies in that market will be explained to a greater or lesser degree by these factors, right? So, in other words, I think the jury is in on whether or not these factors work after decades of research. The question really is to what degree do they work, or which has the most impact in what country or market or region, number one. And number two, at this point, it's a way of actually validating whether a country has a functioning capital market or not, or are the unpriced risks, as we described, dominant in that market and perhaps not suitable for investment. But it's not as simple as simply building portfolios of these factors, right? There has to be a process that harnesses the information that they give us and also controls for various risks that they present, and any investment process presents. Now, the first one is negative interaction effects. So if we think about it, if we wanted to build, let's say, a value portfolio, the simplest thing to do would be to take our universe of stocks, find the one stock with the highest value exposure, the highest value beta, if you will, and just invest in that. The problem with that, aside from idiosyncratic risk, is that one stock may have negative exposures to the other rewarded factors. So in other words, it may have a very high value beta, but it may have negative momentum beta, negative size, volatility, what have you. And the risk in that is that if you invest in that one company with a very high value beta, well, as time goes along, there will be periods where value is out of favor. If the other exposures are not performing and picking up the slack, if you will, then that's going to be detrimental to your portfolio. So what we strive for is to build portfolios, factor portfolios, that have strong exposure to the stipulated factor, for example, value, but also have hopefully non-zero or positive exposures to the other factor. And when you sum all the betas together of a given stock, we call that factor intensity. We're going for positive factor intensity given a tilt towards one individual factor, for example, value. And so this is a major part of our process, and it's a major part of filtering out those stocks that may give you sort of extreme tilts to one factor or another, but over the long term may underperform because they have these negative exposures to other factors. And we call it the HFI filter. and it's really designed to control for these negative interaction effects. Okay. So once we have our universe of stocks, that's our stock selection process, which is essentially a scoring process with the overlay of the HFI filter to account for negative interaction effects. But then we have to weight our portfolios. Now, what many quant strategies do is they select a single optimization model that they have deemed to be favorable in one or more respects, and use that to optimize and determine the weights in the portfolio. Often, other managers will actually mix the stock selection and weighting stage, which we also do not do. So our selection stage is separate from our weighting stage. But what we do is we use 4 optimization schemes, which produce individual and unique weights for each stock in our universe, and then we average the weights produced by each strategy. So why do we do that? Well, first of all, the optimization schemes that we use are heavily tilted towards diversification and the elimination of idiosyncratic risk. So, the first lesson of optimization is you don't want corner portfolios. In other words, you don't want portfolios that have extreme exposures one way or another to a handful of stocks or assets. You want a broadly diversified portfolio because in case your views, if you will, or your signals are incorrect, then you want to have some diversification to pick up the slack and compensate for your incorrect tilting in another area of your portfolio. So, the elimination of idiosyncratic risk and broad diversification is what dictates our use of these individual optimization schemes. Now, why we use more than one is related to model misspecification risk, because no matter how well constructed a formal or mathematical model is, it's nevertheless going to have the risk that it is misspecified in some way or has inherent biases. I don't mean investment biases necessarily, but mathematical biases, if you will. And so to control for that, we use 4 separate optimization schemes and then average the weights produced by each of them to get our final portfolio weights. And again, we do that to ensure diversification and to control for idiosyncratic risk, because our goal, again, is to extract factor premia in the purest forms possible while controlling for various risks, the risks that we've discussed. So a multi-factor approach and controlling for interaction effects is important for a number of reasons. Right? So if we look at this chart, what we see is that factors perform differently in different periods. Okay, so by using equally weighted allocation of risk factors in our multi-factor strategy, we're avoiding estimation risk. And we're also benefiting from the decorrelation and the cyclicality of their premium, right? So we're in our multi-factor flagship portfolio. We've got an equal weighting to value, momentum, size, et cetera. And that relieves us of the burden of estimating and tilting one way or another in a given cycle or regime or what have you. But because it's a multi-factor strategy, we also benefit from that diversification among the factors over time. So in other words, we're trying to win, if you will, across time periods rather than in a specific time period. And that is also another distinguishing feature of how we construct portfolios. Now, what is the end result of this? It is what we feel a robust portfolio construction process that has shown itself to be outperform various competitor strategies. So if we look on the far left here, we see the broad EM universe represented by the MSCI Emerging Market Index. We can see the long-term 5-year performance and the near-term. On the immediately to its right, we see our flagship standard Psi Beta EM diversified multi-factor strategy. And you can see, in terms of both long and near-term performance, our strategy vastly outperforms the MSCI EM index, the broad universe. Now, one step to the right, we see that even with a low carbon overlay, right, for our ESG concerned audience members, we have no drop off in return, and actually year to date we actually have a pickup in return. So, for those plans that have sustainability or ESG goals or concerns, or those that don't, there is not really that much difference in performance. It's really a consideration of values. Now, going to the fourth column, we see that when we say, well, because you may have a question, what about other factor indices, right? Well, we can see here that it's not just a matter of picking the right factors and so on. Our process actually is the reason for outperformance. So you can see here, again, against the MSCI EM multi-factor index, there is, I would say, a fairly significant outperformance, even as far back as the 3-year number. And the 5-year number, we're still ahead, but it's a smaller gap. And then, interestingly, as I had mentioned before, a lot of active EM managers have been coming under a lot of pressure due to underperformance. And you can see the reasons why in the last 2 columns, where their performance has really been inferior to our factor strategy, and really is a source of the criticism that they've been getting. And so we see here we've got the active EM ETF aggregate. So this is an aggregation of the largest active EM ETFs. And then you also have an aggregation of the largest EM multi-factor ETFs. And you can also see that those strategies underperform. So I think the message of this slide is not only does a factor strategy work, but not all factor strategies are created equal. An investment process matters, right? And all the nuances of that process matter as well. So it's important to keep that in mind. And with that, I thank you, and we will open up to questions.